Next question. Reliance Limited is issuing debenture having face value of rupees 1000. It is issued at 10% discount. It is issued for 10 years. It will be redeemed at 20% premium and the rate of interest offered is 16%. Flotation cost is 5%. Income tax rate is 40%. And the question says that you are required to calculate the KD, cost of debt financing. Please go through the question. Let us have understanding of the information of the question. The question is providing the information that a company has issued a security in form of debenture. Face value of the security is 1000. So the face value is going to be used for calculation of the interest amount. It is issued at 10% discount. So the investor is making the payment of 900 rupees to the company. Redemption is at 20% premium. So at the time of redemption, the company is going to make the payment of rupees 1200 to the investor after 10 years. That is a flotation cost at the rate of 5%, that is 50 rupees. Income tax rate is 4040%. Now friends, over here we understand that say we have been provided with the information about redeemable security. Dear students, whenever there is a question of making the calculation of cost of debt financing or cost of preferential capital financing, then in that case I always tell students that say the first thing that say you're required to check is that what kind of information is provided to us, whether the security is issued for perpetuity or the security is issued for a certain time period. If at all the security is issued for perpetuity, then always the cost of debenture is calculated as interest into 1 minus t divided by amount, and cost of preferential is calculated as preference dividend divided by amount. This is the way we make the calculation of the answer. If at all the security is issued for perpetuity. However, if it is issued for a certain time period, let us say 5 years, 10 years, 20 years or so on, then in that case, see, as far as this question is concerned, over here we are required to find cost of debenture. So cost of debenture in this case say can be calculated say by two methods whenever the information is provided to us regarding redeemable security. One is given a name as technically called approximate formula method, and the second is given a name as internal rate of return method, or it is also given a name as yielded to maturity method. Like that, say there are two methods say by which we can compute the cost of debenture, cost of preference share, if at all the security is issued for a certain time period. That is what we understand. Okay. In case of approximate formula method, how we will calculate the answer? That is what I am discussing with you. Dear students, we are required to follow IRR method, or it is also given a name as YTM method, only if we have been provided with that specific information. If at all say we have not been provided specifically that say we are required to follow IRR, the term IRR stands for internal rate of return. Unless there is a clarity made in the question that say we have to follow this method, we don't have to follow this method for answer calculation. We have to follow say this method only for the purpose of answer calculation, that is approximate formula method. How does that work? That is what I'm going to discuss now. So write down a note for this. First point, whenever we are required to find KD, cost of debt financing, or KP, cost of preferential capital financing, then first checking point is that whether the security is issued for certain time period or it is issued forever. Second point, if the security is issued for ever, comma, we will apply following formula. Please write down formula. KD is interest into 1 minus T divided by amount. KP is equal to preference dividend divided by amount. Third point, if security is redeemable in nature, in that case, we have two methods to compute cost of capital. The first method is approximate formula method. Second is IRR method. In bracket write down internal rate of return method. Or YTM method. In bracket write down yield to maturity method. Fourth point, we do not have to follow IRR method unless it has been given specifically. Full stop. So in this question also we will follow the approximate return method, that is approximate formula method. So heading right down, approximate formula method. Everybody is requested to pay attention. Let us have understanding that say how to make the calculation using the approximate formula method. In that, working note number 1, calculation of amount received by the company in bracket write down AR and redemption value of security. In bracket write down RV. So there are two things that will compute. One is AR and another is RV. AR, that is amount received, RV, that is redemption value. Let us understand how to make the calculation of both of them. It's very simple. And why do we calculate? I just explained also that to you. First of all, I'm writing the issue price. Issue price is 900 and that is amount received, part of the amount received, 1000 minus 10 percentage. Then there is say flotation cost. It is 5 percentage. So 1000 into 5%, that comes to 50. Then redemption value. Redemption value is going to be received as 1000 plus 20%. That comes to 1200. So basically what happens at say in the year 0, the amount received is 850. And at the end of the 10th year, redemption value is 1200. This is the first working note that we prepare. What amount do we receive in the year 0? 850. And what amount do we pay at the end of the 10th year is 1200. Please write down this. Why do we compute? I just explained to you in the subsequent my explanation. I request you to take down this first working note, amount received and the redemption value. Now, dear students, let us understand how to make the calculation of answer. See, understand carefully. Calculation of cost of debt financing. The formula will be like this. Interest into 1 minus tax rate. See, what is the face value of the security? Face value of the security is 1000. What is the rate of interest? It is 16%. What is income tax rate? 40%. So what will happen? It is 160 into 0.6. So post-tax basis, cost of interest is 96. That is interest into 1 minus t. Plus, understand carefully, apart from this, there is an additional cost. What is that additional cost? It is redemption value minus amount received divided by the number of years. See, understand that as a company, I make payment of rupees 1200 at the end of the 10th year. As a company, I have received an amount of 850 in the year 0. So what will happen? It is 1200 minus 850. That comes to 350. So that is a cost of rupees 350 that we are incurring, we can very well understand this cost of rupees 350 is consisting of one, the discount of rupees 100. It is consisting of the premium of rupees 200. It is consisting of the flotation cost of 50. So 100 plus 50, 150 plus 200, that is 350. So whatever these expenses that say we are incurring, say these expenses are basically say over the time period of 10 years. So what we are doing, say it is say converted into annualized term. Why? Because say this interest into 1 minus t is in annualized term. So redemption value minus amount received divided by number of years. That is the way say it is converted into annualized term. So it is 350 divided by 3. I'm sorry, divided by 10. This is the way say this cost is also converted into yearly term. And the yearly cost is rupees 90, that is 35. So this is the way we make the calculation of the KD, that is the starting point. I want to explain you first of all the numerator. The numerator for the KD is interest into 1 minus t plus redemption value minus amount received divided by number of years. So it is 1000 into 16% into 1 minus 0.4 plus redemption value 1200 minus amount received is 850 divided by n, that is 10 years. So accordingly, say we have the numerator, that is 96 plus 35, a kind of yearly expense is 131. This is what we understand. Now the numerator is the cost, that is what we understand logically. It is say an amount of rupees 131 divided by, friends, it will be divided with the amount like this: redemption value plus amount received divided by 2. What is redemption value? 1200. Amount received is 850 divided by 2. So over here it is 2050 divided by 2. So it is 1025. And accordingly we make the calculation of the answer. So it is 131 divided by 1025. That comes to 12.78%. This is the way the answer is calculated. Now, as a student, you may be wondering that, sir, why do we divide the same, say, with the redemption value plus amount received? Because many a times the students are having a very valid argument that, sir, over here, instead of dividing with this two, that is average of this two, it should be divided with the amount received only. That is the way, say, we should be having such a value in the division. But instead of having only amount received, say you take over here redemption value plus amount received into 1 by 2. Why is it so? That is a question to which I come across many a times. So I give explanation of the same. See, I completely agree that logically we should be having over here say the amount received. But basically, friends, what happens that the concept is like this. See, there are two methods by which we can make the calculation of the answer regarding the cost of debt financing or cost of preferential capital financing. In that, say this IRR method is an accurate method. This is not an accurate method. That is the reason it is given a name as approximate formula method. Sir, why it is called approximate? You can see that say the answer of that is very clear. See, the amount received value is of year 0 and the redemption value is of year 10 in. So basically the concept of time value of money does not allow us to subtract 850 from 1200. When you divide the same with the number of years, then in that case the concept of time value of money is absolutely violated. That is the reason, say, going with this formula is basically wrong. but still we just want to have the approximate idea. That is the reason say we do like this. Now in order to get answer for this equation, which is say near to the actual cost of the debt financing, what we are doing, say we are making the calculation of this answer which is related or which is near to the IRR, and that is the reason in the division we take average of this two value instead of amount received. I repeat the reason again. What happens, dear students, basically we understand that over here when we are doing working like this, redemption value minus amount received divided by number of years, when we are doing like this, then in that case this equation redemption value minus amount received divided by number of years is basically violating the principles of the time value of money. So in order to say have answer of this equation near to the correct answer of the IRR, we divide the same with the redemption value plus amount received divided by 2. This is the way say we make the calculation of the answer. Please take down answer. I request you to write down answer. So this is the way the KD is calculated, cost of debt financing.